Hi, folks. Dan Bird here with the Daily Scan, brought to you from breakpointtrading.net. Today is Tuesday, November 26th. 2 more days till Thanksgiving. I do have a Black Friday sale ongoing for new subscribers only, unfortunately. My website does not allow me to extend a current subscriber subscription. So as much as I try to work with them, there's no way they can do it. So this is for new subscribers only, but it's a great deal. $24 off the $99 annual subscription, which brings it to $75. And that's good until December 3rd. And just go to the promo code, or actually it's called there's a different name for it. Just type in Rally, RALLY, and you can get the annual subscription. There was a comment or a question from somebody that signed up for the monthly, and they asked why they can't get the worksheet or the risk calculator. Those two components are very valuable. The risk calculator by itself, it took me 2 years to develop, and the paper trade worksheet includes the risk calculator. So I'm not offering that through the free trial, which is part of the monthly. So that is only for annual subscribers. So just because there's so much value there. One thing I want to cover real quick, such a great idea that somebody suggested I put it right on my splash screen. Go through the disclaimer. I am not a financial advisor. I don't make recommendations on stocks. I don't recommend what to buy or sell. Anything I talk about today is not a recommendation. It's for educational purposes only. I don't know your risk profile, your trading style, and everybody needs to take responsibility for their own trades and do their own due diligence. If you do decide to work with an investment advisor, I recommend that you go to this website, Investor.gov, and make sure that they are reputable. So with that, let's jump into it. Today, by the way, is the inaugural session of Technical Tuesdays. So every Tuesday, I'm going to talk about some technical indicator and explain what it does and answer any questions. If anybody has questions about anything specific that you would like me to cover in future episodes, future Tuesdays, just put something in the notes down below. And if you will please like the video and subscribe, that will be really helpful to keep the channel going if it's something that you think is valuable. All right, so let's take a look at what happened first to the market today. We'll go to the home page. And as you can see on the home page, we actually got a little bit of pullback slightly today. So we had a little uptrend and then a pullback a little bit today. And I'll show you why. It's interesting because the reason that it went up yesterday is the reason it pulled back today. And that's all this right here, oil and gas. These four turned bearish. So this is the on the website, it's on the market bias matrix page. And it includes indexes, sectors, industries, relative charts, commodities, metals, and currencies. And it rolls all of this up in a short-term, medium-term, long-term basis into a single component for the overall market. And then that is reflected. The trend is reflected here in the chart, which is on the home page. But the details are here on the market bias page. So you can see down here, the orange line is the short-term trend, the gray line is the medium-term, and the yellow is the long-term. So the short-term is kind of rolling over, but the medium-term is sort of curving up. So basically, it's going sideways right now. But if we look at these right here that make up these components over here, let's start with oil. And the links to all of these are right here on the left-hand side. So start with oil, and you can see right there, oil turned down. So it had an short-term up signal, and today it's a short-term down signal. So very quick reversal in oil. The next one was WTI crude. That also went down today. Brent went down big time today. And gasoline also took a hit. So all of those rolled over, which gave four bearish signals. We did get a bullish signal on cotton short term, and we got a bullish signal on the 20-year Treasury. interestingly, 20-year bonds, interestingly. So we got a short-term up signal on bonds. This could mean that bonds are, there's the signal right there, that's the short term. Could mean that bonds are getting ready to rally, move into positive territory. I think they might be waiting for the Fed to see if they cut again in December. I think they will, but who knows what they'll do. By the way, if we look at 10-year yield, 10-year yield has been pulling back. So it's actually going to give a short-term down signal maybe tomorrow. If it keeps on dropping, it just went sideways today. So, but it's dropped quite a bit in the last couple of days. So if that keeps going down, then bonds should keep going up. So that's what it looks like so far. If we go back to the main homepage, we can look at the NASDAQ. NASDAQ, again, just kind of treading water right there above the support line. And S&P, and I think everything's waiting for the PCE number that's coming out at 8:30 tomorrow. S&P actually looks really strong. S&P actually broke out to new all-time highs today. So 6,021. So that's a breakout for the S&P. So that might be actually heading higher. One thing that I talked about previously was the small caps, in particular the IWM, which is the Russell 2000, and TNA is the ETF that pays 3 times the Russell. As I mentioned yesterday, I exited. I got in right down here. I exited because of that shooting star candle, which normally is a reversal candle. You know, especially when it's at the top of a downtrend. A lot of times, many times, it indicates a reversal. So we did get a little bit of a confirmation today. Tried to close the gap right here. There's another open gap down here. So we'll see if PCE spooks the market tomorrow. And I think that's what's happening here. They're waiting for PCE. If it spooks the market and comes in hotter than expected, or even as hot as expected, because it is expected to go up, then the small caps, which are very sensitive to rates, may sell off as a result. I don't think it's going to last. It could come down here to the 21-day moving average, but that might be what happens. On the other hand, if it comes in lighter, then this could actually take off. So one of the reasons I got out of this is because it's 3x. And that means you get 3x the losses too. If you stay in it and it keeps going down, you get 3 times the losses. So I didn't want to risk that. I'd rather just sit out, wait, watch what happens. Even if it starts moving higher, I can always get back in. But that's where I'm at right now on that one. Okay. Couple of questions I want to address, and then I'll look at the daily scan before I get into the technical Tuesday part of it. So one question that came up from a subscriber on the YouTube channel is, I talked about trailing stops, and the question was, what about trailing limit orders? Do I ever use those, or if not, why not? Well, let's think about this. So on the home page, there's a button right here that says Market Stop Limit Orders Explained. So this explains all the different order types. And let's take a look at it. And I think everyone will figure out why there is no option for a trailing limit order. So first, let's talk about trailing stops. So if the stock is at $10 and you don't want it to drop below 950, or if it does get to 950, you want to be out. So that is a sell stop. So a trailing stop means that if this moves up, you put a component on here that moves with the stock, either a percentage or a dollar amount. So if this moves up, let's say you put $1 on the sell stop. So if this moves up to 11, then this moves up to 1050. And if this moves to 12, then this moves to 11. And the stop just keeps moving up with you. Eventually, when the price rolls over and stops going up, starts to go down, your stop will get hit. But if the price of the security keeps moving up, then your stop moves up with it. Now, let's think about that idea using a limit order. So a limit order, first I'll talk about the sell limit. Sell limit is the opposite of a stop. So limit is the opposite of a stop. One way to always think of this, the stop is pretty intuitive. That's pretty easy to understand. Price is there, the stop is below it. So a limit is the opposite. That means the price is there, the limit is above where the price is. That means you want to sell it if it gets up to a target amount. So if this stock rate goes up to 1050, you don't care if it might go higher than that. You just want to sell at 1050 and get out. So that's a limit order. That means sell it at some point higher than where it is. A buy limit is the opposite. So a buy limit says I'm going to buy it if it comes down to 950. The stock right now is at 10. A buy limit says if it drops to 950, I want to buy it there. And that's what a limit order does. So think about that with a trailing concept. It really can't be done. It's not offered because technically it just can't be done. So how could you say if the stock is at 10 and it goes to 1050, I want to sell, that's a limit order. If you tried to put a trailing limit, that means if the stock goes to 11, then the limit order goes to 1150. And if it goes to 12, then the limit order goes to 1350. Or, it just keeps going up 50 cents above, and it will never, ever execute. With a limit, trailing limit will never execute. Same with a buy limit on the bottom. If it's at 10, you say, I want to buy it at 950, you put a limit order in. If it gets to 950, it executes. But if it's a trailing limit, that means if this goes down to 9, then this goes down to 850. And if it goes down to 8, then this goes down to 750. And the trailing limit just keeps going down as the stock drops, and it never, ever executes. So it just simply does not make any sense to have a trailing limit. And that's why they're not offered on most platforms. So hopefully that's understandable. It's kind of intuitive when you think about what these do. But if you ever have a question, just come to the homepage. This is available to anybody. You don't need any subscription for this. And just click on this button right here, and it will explain all of the different types of orders. And it explains stop, limit, all of those kind of things. All right, next is the daily scan. Let's take a look at that. And we'll get stopped out of another one today. So here we go. Stopped out of Soundhound. Now, if you remember, I've got a note over here, short squeeze candidate. So Soundhound was a short squeeze candidate. Let's look at the chart. We got in right here. The next day it gapped up and went way up here, which was great. And then yesterday it started pulling back, but it did not get to the halfway point of this candle. And where I had set the stop was, I thought I actually had it in here, but oh, you know what? I didn't save it to my spreadsheet. So let's do this. So there it is. So there's where the stop was. We started off with a stop down here. This is the buy point. The stop was down here at 630, I believe. Gapped up, went way up here, went all the way up to almost $9. And we moved the stop up to the top of resistance right there. And it got stopped out today. So that's okay. I would rather get stopped out than see it continue to go down. Now, this could come down to the 21-day. It could reverse and go back up. Who knows? But at any rate, we're out, and we're out with a profit, 10, almost 11% gain in 5 days. So basically 10%. This truncates the decimal point over here. So in just 5 days. Now, what this does for our overall portfolio, which is tracked up here, the win-loss ratio right now, these numbers up here include the ones that are still pending. They just, because if these stop out where these stop losses are, that's what we'll make or lose. So we already know that we've got a current risk. We already know we have a gain of 9.6 if all of these stop out. If the whole market turns around, they all stop out, unless they gap, of course. But just assume that they all continue to move down, and we'll have a 9.6% gain right there. So overall, with the portfolio right now, the win-loss ratio is 72%. Our goal is 40%, so we're well above that. You might say, why would you have a goal of 40% for win-loss? That means 4 out of the 10 trades you do are wins, but 6 out of the 10 are losses. Well, that's fine as long as your losses are smaller than your gains. So we want to get out of things that are going down as quickly as possible, and we want to keep the ones that are going up as long as possible. So maximize your gains and reduce your risk as quickly as you can. All right, so right now the gain loss percent is 12% overall. And that, again, is assuming all of these stop out. You can see, right, actually it's 12%. That's a real number. Right now it is 12%, and you can add the 9.6 to it if these all get stopped out. So we have about 21%, but the important thing is the number of days. So just about a month, we've made 12%. That's not a bad return. Average trading days, that's the average time that we're in these trades. You can see over here on the right, different times. The longest one is 16 days with Powell. Shortest one is Uber, which we bought just before earnings, 2 days before earnings, in fact. Only in it for 2 days, but the average is 6 days, 6 trading days, and we have 12%. So pretty good. So that's what it looks like right now. Let's see. I think ones that are getting close. Kava, I think, was close to stopping out. There's Kava. So it's started moving up at the end of the day, which is positive. Came right down to the 21-day, interestingly. And our stop is, so the 21-day is at 140 and our stop is at 139. So just below the 21-day. We'll see if that continues up tomorrow. If it does, that'll be great. If not, we'll be stopped out. That's just how it works. Oracle was starting to come down. Oracle is still a little ways above the stop. So what we'd like to see on this is for it to come down. It started to move up today. So we'd like to see it to pull back and then start moving higher. So if this goes up and it takes out these previous highs right here, we're going to move the stop up to the right below where this bottom is right there. So far, Oracle looks okay. DocuSign is our biggest winner right now. Now, DocuSign is one that I started running the worksheet before I actually made the actual trades using real money. So it's not in our portfolio. I'll show you what that looks like. So this is using E-Trade. So these are the ones we're in without DocuSign. But you can see right here, it's 2,200 gain. This does not include the gains that we have for the ones that were stopped out. These are only the gains from what's right here. Only one of them is negative, and that's Intel. For the day, Intel went down and VRT went down for the day. But VRT, you can see, has 1,100. That's almost half of the portfolio just in that one stock. And that's actually what typically happens. You don't ever know which one is going to be the one that really takes off. So you want to find good stocks, and I showed how to do that in the very first video. Find good stocks, buy them after a pullback, and then hang on to them, move your stop up to break even, and keep moving the stop up, and hopefully the stock just keeps going higher, and the stop moves up with it. That's the idea. If I look at VRT, there's the stop right there. It's still coming down, so could come down and get stopped out. I think our stop on this one is 125 is where we are. So again, that's right, the 21-day moving average, and that's usually a reversion to the mean. So we'll see. But you know, we bought that all the way back here. So all the way, it's only a month, less than a month, 3 weeks ago. But it's done pretty well since then. So we'll continue following this, and hopefully it'll keep moving up and we can move our stop up a little bit. All right, that's where we are with the worksheet. By the way, the worksheet I don't update it every day. So if you download it and say, hey, it doesn't look quite the same, just give it a day or so and I'll get the latest one up there. But the worksheet can be used by anybody. It has a risk calculator in here as part of it. This risk calculator took me 2 years to develop, but this is what tells you how many shares you can buy right down here. Oops. And it gives you a definition of average true range as well. But that's what the risk calculator does. Basically shows you how many shares you can buy based on your portfolio, based on the ATR, average true range, it's the volatility, and based on where you set your stop. So you cannot use the risk calculator. You cannot figure out your sizing, your position sizing, unless you know ahead of time what your stop is going to be. So right over here, you see it says 85.90. That's 2 times the ATR. ATR is the average true range. It's the average range that the stock moves in one day. This is for Gilead, by the way. So 205 is what it typically moves in one day. And this is just a suggestion. You don't have to abide by it, but a suggestion is 2 times this minus whatever the price is. So that would put the stop at 85.90, and I actually put the stop at 86. So I actually didn't even look at that when I set the stop, but it's pretty good. That's 4.4% loss if it gets hit. So that's what the risk calculator does. The order definitions are in here as well, that I showed before, as well as some other things. So that's all part of this worksheet. So this worksheet is very valuable. You have to be an annual subscriber in order to get access to this, and also the risk calculator, because there's so much value here. The monthly subscription gives you a free trial for 7 days, and I don't want people just to download this and go away, of course, because there's a lot of value here. All right, so that's it. So let's get on to the Technical Tuesday. The topic for today is, this was a question that somebody asked me, is what's the difference? I don't really know the difference between MACD and PPO. So what is that? Well, let's first go to, this is stock charts. And on stock charts, I'll just go here. I'll go back to actually any page on stock charts. This is the main page right here. You can see Bitcoin dropped today. By the way, Bitcoin went to, I said it was going to go to 90. It actually went to 90,000 something, just below 91. And it may not be done, so it may continue going lower. There's the Dow had a great day, S&P had a great day, NASDAQ not so much, just sort of sideways. Small caps down. Small caps went down, or mid caps went down too today. So I think they're all waiting for the PCE number tomorrow. Utilities and healthcare were the 2 top sectors today. And on the right are my top 10 combined lists, which is what I use to run the scans. This one here actually showed up on one of the scans today, SGMO. If anybody's interested, I did not add any scans today. I'm also waiting for PCE, but this one is only a $2 stock. So you can see the chart right there. It looks like it's ready right now to start taking off. So that might be one. We'll continue to watch it. Maybe we'll still add it. So anyway, that's what it looks like. So let's take a look at, so right here on Chart School, anybody can go here. You don't need a subscription to stock charts. If you want to learn about technical analysis, click on Chart School, and it will allow you to look up anything you want. Or you can just watch my channel on Tuesdays, and we'll talk about something. So we're going to talk about the PPO, which is the percentage price oscillator. Percentage price oscillator measures the difference between 2 moving averages. Its cousin is the MACD. So the MACD and the PPO are very similar. And when I say 2 moving averages, I'm going to use SMCI as the example here. So the MACD, if you'll watch it down here, these are the 2 moving averages. And MACD is called moving average convergence divergence. So when the moving average lines converge, they pull back together. And down here is the histogram, which measures the magnitude of the move. So when these moving average lines converge, then they're going back to neutral, and they might be changing direction, changing trend. So you can see right up here where they converge. Right here they converge. Trend looks like it's changing. Or they could diverge. You see here where they're diverging, and the trend is accelerating in that direction to the downside. You can see here where they diverged. The trend is accelerating to the upside. So moving average, convergence, divergence. That's what it measures. Now, why is that different from the PPO? Well, let's see. That's not what I want. I want this. So let's go down further down, and anybody can look this up. So PPO generates the same signals as the MACD, but provides an added dimension as a percentage version of the MACD. PPO levels of the Dow, it basically allows you to compare two things because it's using percentage instead of an absolute value, which explains down here. That's frequently asked questions. Okay, so because MACD is based on absolute levels, large price changes can affect the MACD levels over an extended period of time. If a stock advances from 20 to 100, its MACD levels will be considerably smaller. So the PPO solves this problem by showing MACD values in percentage terms instead of absolute terms. So I'm going to show you an example of what that does in a second. Down here, frequently asked questions. Can I compare PPO readings for different securities? Yes, PPO readings for different securities can be compared, even with large differences. That's one of the advantages of the PPO. You can compare something like the NASDAQ that's selling for 12,000 to something that's selling for $10. You can compare the two because it's using percentage rather than absolutes. What does it mean when PPO is positive or negative? Negative. Shorter moving average is above the longer one, indicating strong upside momentum. Conversely, PPO is negative when the shorter moving average is below the longer one. So if we go back here to SMCI, you can see right here, the short one is the black one, and the longer one is the red one. So red one is the signal line. So when it's above it, that's bullish. When it's below it, that's bearish. And it'll give you an indication of where those trends are changing. What's the difference between MACD and PPO? Well, both are similar. There are key differences. MACD are affected by the price of a security. In contrast, PPO is not subject to the price level of the security, and thus PPO readings for different securities can be compared directly. Can I use PPO to identify overbought and oversold conditions? PPO may not be the best oscillator for identifying overbought or oversold because movements are unlimited in theory. And I'll show you what this means in a minute. Oscillators like RSI and stochastics are generally better suited as their levels are limited. Now, what I like to call that is bounded or unbounded indicators. So the indicator at the top is the RSI. The RSI is an oscillator that oscillates between 70, which is overbought, and 30, which is oversold. So this is a good one for identifying overbought and oversold levels. And usually what you want to do is wait till it's overbought and starting to move down. When it breaks back down through that 70 line, which is right here, that's an indication that long bullish trend may be petering out. So it finally went below right there, and started going down. Same thing with oversold. Down here it's oversold. It went above the 30 line right here and got a little rally. But it went back below it again, went above it again here, and got a little bit of a rally and actually just went sideways, and then did so again right here. And now this might be an even better rally right there, but really not sure yet. You want this line to be above the 50 level and preferably above 70. Now, with a bounded indicator like this, it can stay overbought or oversold for extended periods of time. So like I always say, never, ever use just one indicator. You have to use multiple indicators. So this is a bounded indicator, and stochastics is bounded as well. It has an upper and a lower limit. MACD, however, is unbounded. It could theoretically just keep going higher. If SMCI just continued all the way to the moon, then the MACD would continue all the way to the moon as well, because there's no boundaries for it. So this is an unbound indicator. It is not good for identifying oversold and overbought levels, but it is good for identifying trends and the magnitude of the trend. So now let's take a look at the PPO and see what that looks like. This last one down here, what can the PPO tell me about volatility? By comparing PPO ranges of different securities, you can gauge their relative volatility. Security with a large PPO range is generally more volatile than one with smaller range. And that's true of the MACD as well. But let's take a look again at SMCI, and I'm going to remove the RSI for a second because I have explained bounded and unbounded using that. And I'm going to add PPO. Now, one thing you may notice is that the default settings for both of these, MACD and PPO, is 12, 26, 9. So 12 and 26 is the fast moving average and the slow moving average, and 9 is the guideline that we're crossing. I like to use Fibonacci numbers. It is completely optional. You're not going to see much difference either way. So if you don't want to keep changing the numbers, just go with the standard. There's absolutely nothing wrong with doing that. The Fibonacci equivalents here would be 13, 21, and 8. So they're pretty close, 13, 21, and 8. So I recommend, especially if you're just starting out and learning indicators, just go with whatever the defaults are. These are usually defaults that were set by the person that created the indicator. All right, so now we're going to compare these two, MACD and PPO, and this is a good stock to compare it to. I also actually want to make the height 1. So you're kind of getting a lesson in stock charts here too. So I'm going to make the height of that 1 so that they're the same. They look the same. All right, so it looks pretty similar, right? PPO and MACD looks pretty similar. But by using it with a stock like SMCI, because it moved so much, moved from basically about 30, 28, maybe $25 all the way up here to 120. So that was a huge move. This is a great one to actually show the difference between absolute values and percentages. So what you'll notice, they look very similar, but with MACD, you can see that the MACD line actually made a new high when the stock made a new high. So there's the previous high, there's the new high. And you might think, well, that's what it should do. Well, that's true. If you're using absolute values, that's what it should do. But that's not really helping us to understand the internals of what might be going on. Using percentages, it's a much different story. Now, instead, we can see as the stock moved higher, right there, and MACD moved higher, but PPO moved lower. So PPO, that's a negative divergence. That's one of the best ways to use this particular indicator, is use it for my favorite ways of using it is looking for divergences like this and looking for crossing of the zero line. So just think about it. These are moving averages. And by definition, moving averages are always lagging. So if you have so 1226, right? So 12 days that we're adding one day and we're dropping off day 13. Then we add the next day and we drop off day 13. But by definition, that means that this is lagging. It's not going to be as the price actually moves. It's going to be a little bit behind it. So, however, so when it gets down to zero, that means it's equal. That's equilibrium. Basically, it's neutral. So usually the stock's moving sideways. So if you'll notice where that is, and we follow it up here, pretty much was moving sideways. But when it goes below zero, that means it's confirming a downtrend. So below zero right there, it's confirming the downtrend. The downtrend continued lower. But one of the most powerful things, and this doesn't happen very often, so you have to watch for them, is looking for divergences like this. So the other thing you might notice is over here, when we got this rally in SMCI, the MACD was actually moving a little bit higher, even as the stock was moving sideways, but then lower. But with the PPO, it was decidedly moving lower. So if we just took this little section right here, and we're just looking at this part, let's say the rest of it had not happened yet. If we're just looking at that part, the MACD would have been saying, oh, looks like it's getting ready to go up. So that's right here. And it did go up slightly. But the PPO was saying, well, even though the stock is moving sideways to up, the PPO is moving down. So again, that's a negative divergence. So you might be wary about getting in at this point And sure enough, it crashed right there. Now, this PPO, because it's percentage based, has the magnitude of the move. So the magnitude of this all the way down here is the magnitude of this move down. And now it's telling us that it's now crossed, which means it might be getting ready to rally back up. You don't really know because this isn't above zero yet. That's what I like to look for. I like to look for these things to go above zero, the black line above the zero line. The histogram just gives you magnitude. So when I say above zero, I'm not talking about the histogram. I'm talking about the black line right here. So that's the difference between PPO and MACD. You can try to look at both if you want to. There's really not much reason to because they pretty much look the same. In fact, for most stocks that don't move with this kind of magnitude like this, you're not going to notice much difference at all, especially if you're looking at a 4-month period. If we look at it like this, this is the PPO up here. I always use PPO instead of MACD. So there's the PPO right there and starting to move up, but it's not above zero yet. So that's the key. And it's hitting the 50-day moving average right there and looks like getting rejected. So that might be the end of its move, might be the end of its rally. We'll see. All right, so that's PPO. Hopefully that will explain to everybody why PPO and MACD are different. Let me know if you have any questions, or let me know if there's any particular indicator you'd like for me to look at. If not, I'm going to pick one. I might pick one anyway. It doesn't mean I'm going to choose yours because there's certain indicators that are really important that you should always be looking at, be watching at least. And I'll cover those in a future Technical Tuesday. So other than that, if you would like to subscribe and take advantage of the Black Friday special, promo code is RALLY. If you just click on this button right on the home page, it takes you to the sign up page. And right over here, it says enter a coupon code. Where it says coupon code, just type in RALLY, RALLY, and it will take this down to $75. And then you'll get access to right over here, the risk calculator. You need an annual subscription for that. To get to the worksheet, you go to the portfolios page, and the worksheet is right down here. Also, you need an annual subscription for the worksheet too. All right, that's it for tonight. We'll see what happens with PCE tomorrow. Question was, am I going to do a live show? No, I will not. Everybody will know what happened with PCE as soon as the market opens. Actually, if you're looking at futures, I'll talk about futures in a later session. But if you can see futures on your platform, that's what can tell you before the market opens what's going to happen. So watch the futures direction, and we'll give you a clue of what's coming. All right, that's it. Thanks everyone for watching. Breakpointtrading.net is the website, and the YouTube channel is right in the upper right of the website, so it's very easy to get to. And I will talk to you again tomorrow. Good luck trading.